Good morning, guys. It's about 7:10 on October 2nd. So just wanted to get in real quick and show you how easy it can be to find something to pay a bill this month. So let's say I'm looking to just pay a simple cable bill or a phone bill this month. What am I looking at? $50, $100, something like that. So let's go into the markets, see what we can find to pay that simple bill and see just how easy it can be to make a little bit of money without risking a whole lot. So let's say you've got $2,000 sitting around. What can we do with $2,000 to pay a bill? You can leave it in the bank, make 1%, make $2, or you can put it in the market and help you pay a bill. So let's get into the chart to see what we can find. So right now you're looking at the options chain. Hopefully you've been through that cash secured puts and covered calls video that we posted a few days ago to see how this actually works. If you haven't, refer back up to that, take a look. But let's go over to the charts and see if we can find something that looks good. So you can see this red line and this blue line. This red line is the 300-day exponential, which I use kind of as just an average price for this stock. So if I look at the stock, I say, what is an average price and are we around that average price? The blue line is the simple moving average. Same thing, 300-day, and you're looking at a 4-hour chart. And for me, this just gives me a good baseline of where price should be hovering, either above or below. If it's below these lines, I know that I can get a pretty decent cost basis selling a put. What that means is that if I'm below the average, because I'm selling a put below the average, at some point I would expect my price to hover back up to the average. It's called mean reversion, but don't have to worry about that right now. All I need to worry about is what kind of premiums are we charging if I want to make money this month. So I can see we're under this 300-day moving average. Looks like down here we've got a level of some type of support. So let's see where we're at. So this level is $11, and all I did was created a alert for this $11 area. So if I say I'm willing to buy this stock, which is American Airlines here at $11, how much money could I make off of that? So let's go to trade. We'll go over to the options, and then these are our expiration dates. So if I head over here, I can see an expiration date for tomorrow, which is Friday. The $11 has an open interest of almost 10,000 contracts and a delta of $20, meaning that this, not exact meaning, but you can translate it to, this has about a 20% chance of actually getting assigned. So right now our price is $11.33. So any movement today or tomorrow can go up and down. If this stock ends up, say, at $10.50, we're going to get assigned at $11, and we'll take a 50-cent per share loss on this contract. But we'll get assigned $5 right now if we were to sell this. Markets aren't open, so this won't happen, but that doesn't make a whole bunch of sense. So let's move this out a week and see what happens. So we moved this out a week. We can see our delta has moved up to now we have a 35% chance of getting assigned, but we can collect about $24 in premium. That's actually not bad for 8 days. So something to think about. Probably not what we're going to want to go with. So let's go see if we can find something else. And all I'm doing is kind of trying to hunt down something with some decent premiums. So I can take a look at this chart. This looks a bit extended and looks like we may be coming back down. So I don't want to jump into that right now. Webull, what do you look like? Webull looks like we're going to be coming back down, but we've got 2 levels here of support again. So if I had to look at this and say, this level looks pretty interesting, set an alert for there, set an alert for here, and look at these 2 price levels. So we've got 1377, which will round to 1350, and then we've got 1250. Both of these are either below or in between our 2 moving averages. So let's take a look at options there. Let's go over to our trades. We're about 8 days out. And the levels, again, that we were looking at are, let's say, 1350 and 1250. So our 1350s, wow, for an 8-day expiration, our 1350s here with a 35% chance of getting assigned are paying $80, $76 to $80 per contract. That is a great premium. The reason for that is probably because we have really high implied volatility. Implied volatility is exactly what it sounds like. It is volatility. And because the volatility is higher on the stock, you get paid more to hold that insurance policy against it. This is one that I would definitely consider. And because our target, let's say we're just trying to pay that bill, we're trying to pay the $50 phone bill, $80 phone bill. If I'm looking to make $50 off of $1,300, I'm probably going to look at this strike in the 13s or maybe even this 1250 to give me a little more cushion on this trade. If I can, for an 8-day expiration, if I were to go ahead and sell this 1250 with a 21% chance of getting assigned, that means I have, a 79% chance of not getting assigned. My chances of not getting assigned on this are very, very high. That sounds like something that's really interesting to me. So in the morning, go hunting, see what you can find. But this is a really easy way to make, $36 to $40 for doing a little bit of extra work in the morning. So just wanted to show you a great example. Go from there. Hope this helps. Talk to you guys later. Bye-bye.